you're not getting financing from a bank unless you have a lender that's willing to hear your story and share it. That's the difference, right? It's like, yes, a lender will hear your story, but are they willing to share it on the other side when they get back to the office? And that to me is understanding that dynamic is very important.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owners Association, where real estate investors have found success since 1968. I'm your host, Brian Hamrick from Hamrick Investment Group. This episode is sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB and Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com. Hello and welcome to episode 451. As a real estate investor, you may have noticed that it's gotten a lot more difficult to acquire financing for your projects. That's why it's so important to build your lender relationships. Often, it's these relationships that will help you find creative and workable solutions for sourcing and maintaining your loans. Today, I'm thrilled to speak with Bobby Fisher, who has helped me source many of my loans under some very challenging circumstances. Bobby is a top West Michigan area commercial loan producer and has expansive experience in commercial real estate and commercial real estate development lending. He's also the vice president of commercial loans at West Shore Bank. Today, we're going to discuss how lenders perceive investment opportunities, why it's so important to cultivate your lender relationships early, and the importance of creativity in structuring a loan. Bobby, welcome to the show.
Appreciate it. The intro makes me feel good about being here, man. I appreciate it.
On past episodes, I brought up multiple times the Scenic Drive Resort, which is on Lake Michigan, which we could not find anyone who would extend a loan, like wanted to work with us on the lending for that project. And you and West Shore Bank were the one group that stepped up and said, yeah, we'll do that. So I'm thrilled to have you on the show, and thanks for all your help over the past years.
You know, that project is really indicative of a lot of things we're going to talk about today, because I think you guys were on the front end of some of the issues we had to address and figuring those out early on. So I'm looking forward to talking about it.
You have your ear to the ground. You see what's going on out there in the commercial loan world. As we speak, it is early June of 2024. This will probably come out early August. So we're still waiting for the Fed to cut rates. You know, loans are still, in my mind, difficult to get. But what are you seeing? What's going on in your world, and what are you noticing?
You know, as you mentioned in my intro, I do a lot on both like existing properties and development, probably with the majority of my time spent on development. And really, the headwinds that have faced developers over this last, I'm going to say, year and a half, have been quite difficult, right? So the combination of increasing rates on the interest side plus increasing costs, and then really starting, because it takes so long to get projects off the ground, your initial estimate on costs and things have changed so much in that time period. That's really the main area where I've seen the biggest difficulties for borrowers, right? I was reading an article in the Journal yesterday, the Wall Street Journal, and it talked about the length of time it's taking projects to get off the ground. Specifically, this was in the multifamily apartment space. And right now, from the construction authorization to actual completion, the average time is taking 500 days, right? In 2019, it was 320 days. And just that right there said that I think that's a product of a number of different things that I'm seeing in the marketplace. And it's a combination of, you know, municipalities having to think about things differently, and maybe some being stretched in ways that they haven't been before because of the types of projects that are out there. I think it's also, again, kind of coming back to banks getting a little bit skittish, not putting the brakes on everything, but getting skittish on some of the things they're seeing when it comes to rates. And some of the, I think before there was a lot more leeway because rates were so low and costs were more in line, there was more margin of error. And I think that margin of error has declined a lot. And so there's just a lot of headwind in what I'm seeing across the board, specifically in new development projects.
From what I'm hearing is there's a huge drop off in new developments, you know, groundbreaking for new multifamily and apartments. There might be, in some parts of the country, there's a lot of new supply coming online. But in a couple of years, there's going to be a real deficit of housing because of just the lack of new groundbreakings that's happening right now for multifamily and apartments.
I was sitting on a nationwide call for a user group that I go through for a group we do participations with, and it's on larger commercial real estate projects. And it had some leadership from people who hold a good chunk of doors, both in the Midwest and northern part of the country and in the Sun Belt. And that was the exact discussion on that group was, hey, the number of doors going in right now is going down, and the majority of those are in the affordable housing category. So when you kind of break it down even more on the number of doors, the market rate apartments and some of the shortage that we have across the board, I agree, it's going to be exacerbated over time because they're just not getting built right now. We ran into a unique situation because if you look right now, I'm sure we've all seen those Bowen research reports that every county and every municipality is doing. And it's kind of nice for me because it's the same format every time, so I know exactly what table I'm looking for in all these reports. But what those reports are all saying the same thing is, hey, there's a really big shortage in Michigan. I'm going to talk about Michigan specifically because that's where I'm seeing these reports from. There's a large shortage in housing across the board, and that's not unique to any one strata in the income categories of that housing bucket, right? And so what I'm seeing is counties are going and doing that so that they can get access to some of the funds that are available for people to develop in their particular counties, right? But a lot of times those reports are designed to get dollars designed for affordable housing at a percentage of the average median income AMI. And so what's happening is, yes, there's a lot of dollars out there, but then it's getting more competitive to get the dollars because of how many people are trying to do projects within their particular county. I'm realizing as I'm saying all this, it sounds really doomsday dark out there for me for developers, but I think what I'm trying to say is that understanding what different tools are out there and how that might change the lender relationship and the financing structure will put you in a competitive advantage as you start to look at some of the investments people are thinking about doing.
And when we're talking about multifamily housing and development, and what I think you just hit on it in your capital stack right now. These projects don't pencil out unless you're getting some sort of money from the government, whether it be tax abatement or grants. And a lot of that money is tied to lower income, 60% AMI, 80% AMI type of housing. So those are the only projects, or in a lot of cases, those are the projects that have money to actually move forward. But there's a real drop off in the market rate housing, and we're gonna see that. What's the solution right now? I mean, are you making loans? Are you seeing loans getting done on market rate apartments?
It's limited. I think I have 3 similar size apartment projects going in. And I think this is a microcosm of what's really happening in the marketplace, especially after, that discussion, on that investment call I was on. And each project is, I'm going to say 50 plus units, say 50 to 85 units. One of them is market rate and 2 of them are affordable housing. And on that call, they said across the country, they're seeing about a 50 to 60%, more like 60% market rate. But the reason, or I'm sorry, 60% affordable housing, right? The reason that the market rate apartment is going to work in the one that I'm doing is because they were able to get grant funds that weren't geared towards affordable housing. So it's still, even though it's a market rate apartment, there's still funds available in certain buckets that made that one pencil out. And a lot of times it has to do with, kind of going back to those Bowen research reports, for the municipality, that was part of it, right? The need was so glaring for that particular area, that strata of housing, that the grant project was able to get behind it. And so it can be done still, but even on those ones, the capital stack has to have other things in it because it's not worth it for investors to put their own money in at the level it needs to go in. The return's just not there.
There's this really strange perception out there that there's a huge need for affordable housing or lower income housing where it's subsidized and it's just less expensive. But really, here in West Michigan, in Grand Rapids, Muskegon, where that project is that you're talking about, there's a greater need for market rate housing. And people don't realize that the need for market rate housing exceeds in a lot of places the need for lower income housing.
Agreed. And I think it's a function of a number of things, right? Because when rates, so back, I try not to always refer to the Great Recession because I feel like we did that for like 10 or 12 years, then we just kind of got tired of it. But what happened was banks got really uncomfortable with new builds and speculative building that was happening so much prior to that. And so for about 10 years, we didn't build anything. So when we talk about that shortage in the market rates, I really think it's a function of just not having built anything from '08 to 2018 and just being so short in that category and not necessarily just in the multifamily, in like individual houses for people to buy. Because you look across the country, specifically in West Michigan, the supply for market rate living space, whether it's an apartment or a house itself, is significantly undersupplied. I mean, I had my boss's kid was looking for a house in Grand Rapids, and he had one house that he put a bid on at a market rate, just like that really in between number, and there was 45 offers on it, went for $50,000 over list price. That's an economic issue on supply and demand, right? So and it's a historical kind of path dependent on what happened in '08 to 2018, where now we just have to contend with what that looks like.
It's really a severe housing shortage, and it's a market rate and not just affordable. But what does that mean to the landscape going forward? I mean, how does that change the nature of lending, both in the construction and development world, but also just the acquisition world? I mean, what do you anticipate over the next couple of years it's going to look like in the type of deals you're making loans on?
With the rates, it's I think there will be a sweet spot for borrowers where you can get a return. Like, I know people don't like to hear this, but I think that rethinking the return on capital, if you are willing to put a little more into it, right? So if rates are higher and you have to manage at a certain cost, there can be a return on dollars because of just what the alternative investment options are. If you keep your loan numbers down, whereas, okay, before you were getting 80 or 75%, does it make more sense to do 70 or 75% because you can make that deal work now in the numbers, even though your direct return on cash may be different than it was before. So I think part of it is we're going into a time where some of the return that we expected before may not be as heavy as it was because of some of these factors. And I think that's where I'm seeing the biggest rub is that expectation of what my expected rate of return was before. I see that changing, and that's always a hard one to accept, right? Like, hey, I was getting this return over these 5 to 7 years at this rate, and I think that you can still get a fair return. It just might not look exactly like it looked historically, if that makes sense. It's kind of like the stock market, right? Stock market goes up, I have really good return for a few years, return's not as good, but it's still palatable. To me, I think that's kind of where I see it going, especially in the acquisition side of things. I mean, some of the economics have to adjust to make that make sense, but I do think that's where it goes eventually.
It really seems like, whereas leading up to this inflationary period and the Fed's unprecedented rise in interest rates, the idea was, let's put as little down as possible, and then let's double or triple our money in 3 years. And those were the kind of returns that a lot of investors were looking at. But, my takeaway from what you just said is that's changed. Now you're going to bring more equity to the table. You're going to put more money down, and your timeline is going to be longer because you're not going to be able to double your money in 2 years. It's going to be a longer timeline, and your returns aren't going to be that 20% IRR or whatever that people were trying to achieve and were achieving before the Feds raised the interest rate so high.
And I think, kind of going back to what I mentioned earlier, is I'm not sitting here saying, hey, this just doesn't make sense anymore. It's all bad. That's not what I'm trying to say. What I'm trying to say is even as a lender, I need to think about what the mechanics of the projects I'm looking at are, because I'm not going to see the same things either. And so I think when I talk about that margin of error I talked about before, that's on both sides of the table. One of the things I think we're going to segue into now is just that lender-borrower relationship. And I think the expectation, especially when it comes to those a community bank like mine, as far as really being willing to work with borrowers on especially community impact type of deals, I think both groups have to have an understanding of, there's kind of going to have to be come alongside and like, let's do this together because that's what it's going to take to make this work mentality because of what we're saying, right?
I'd like to take a moment to tell you about Green Property Management. Not only do they manage everything from single-family homes to apartment complexes in the West Michigan area, they also manage my entire portfolio. So I can tell you from personal experience that their unique flat fee management style is worth a closer look. If you feel that your property isn't operating to its fullest potential, then Green Property Management can help you take a holistic approach that will save you money, eliminate your headaches, and increase your net income. And if you're a property manager interested in applying Green Property Management's model, give them a call at 1-866-95-GREEN or visit them on the web at greenpropertymgt.com.
If you're thinking of leaving your W-2 job and becoming a full-time real estate investor, one of the greatest costs you must consider is healthcare for you and your family. When I made this transition myself, I found the whole healthcare insurance process to be confusing and frustrating. That's why I'm glad I met Chad Creasy at RCB and Associates. Chad is a professional health insurance agent who helps real estate investors and small business owners understand and choose their best healthcare options. And best of all, his services are covered by the insurance company and won't cost you a dime. If you live in Michigan and are expecting a change in your healthcare insurance coverage for any reason, or losing employer coverage or transitioning into Medicare, then you owe it to yourself to contact Chad Creasy at rcbassociatesllc.com. Break that down for us. I mean, when you look at a potential loan that, an investor brings you a project, say a multifamily deal, and they show it to you, what are you looking for? What do you want to see? And in many cases, what is it that the borrower doesn't even understand that you're looking at?
It's funny, I made some notes before this, just prepared. I'm like, okay, what really is the gap that I feel like happens between a lender and a borrower, specifically development and kind of the group that we're really talking to today, right? And what it comes down to, I boil it down to this, right? You bring it to me as an investor, Brian, and you say, okay, this is the upside. This is really where I think this could go and what this could be. And I look at you and I say, yeah, but this is the downside and where I could go and I think it could be, right? And so like you have this spectrum of like the bank coming at it this way, the investor coming at it this way, and you got to meet in the middle. I'm like, okay, I can live with that. And so what I say that, I kind of say that half joking, but we all know banks are, risk averse people with our money, right? So what I was thinking about, I'm like, okay, so how do you get a bank more comfortable with what you're doing? And what it comes down to is the assumptions you're building into that optimistic scenario that you bring to the bank is going to continue, and I would say even more so, be weighted on future-looking projects. And the reason I say that, it goes back to this margin of error. I feel like that's going to be the word of the day, is margin of error, kind of, how that's so much more limited. Because if you have assumptions that are supported by feasibility studies and supported by past projects and things like that, a bank can explain away some of the heartburn they may have with the assumptions being made. But if you don't have that extra layer and those third-party validations of what you're bringing to a bank, that's where you're going to run into issues. And so one of the things I mentioned to you is like, hey, I think it's important for your listeners to know that engaging banks early in projects, there's value that can be added to that. Because the assumptions that you're making today, if I'm going to go back to that 500-day example, if you have a new build that you've authorized, and it's going to take 500 days, a year and a half to build, the mechanics of your assumptions very well may change, and I would argue are going to change in a year and a half. If you have a lender engaged and you're touching base with them quarterly or every 5 months as you're working through that, you're not going to get a surprise at the end of your 400 days when you're getting ready to close the loan that your rates or something has changed in the dynamics of what the bank is looking at. You're going to be on top of that. And so I think it will save a lot of time, headache, and energy if you have your lender involved early once you get an idea of what that scope is going to look like because of the things I'm saying.
If you're in acquisition mode and you're buying an existing commercial property, say multifamily, at what point would you want to get involved as a lender?
For me, I actually like it when people call me before they go to do purchase agreements. I think a lot of investors, I want to credit investors. I work with people like yourself who are well seasoned, very smart about how they go about it and can get a long ways without me. And that's fine. But I think that when I know something is coming and you're going in to make a purchase agreement, for you to understand what that lender is going to be looking for, that's one of the things I never completely understood. And maybe you can provide color to me as a lender and just for your listeners so I know better. Why investors don't get a lender involved before they do a purchase agreement, because they're just making assumptions based on their last project or what it may have happened in the past. And I think that to me is very helpful when I can provide some insight into what they'd be up against in my mind.
I think it's the let's hurry up and get this under contract mentality, and let's worry about all that stuff after the fact. I want to bring up something I heard on, I think it was the Radio Guys podcast a long time ago. And it's this difference between the residential lending world and the commercial lending world. And of course, in the residential, the emphasis, you're looking at the borrower. What's their W-2 income? Can they pay the loan? But in the commercial world, you're looking at the property. And you really, as a borrower, you need to look at your commercial lender as your partner in all this, because they're looking at the same property you're looking at and the same numbers you're looking at. And if they see it differently, then there's probably something you as a borrower are missing. So that is a very, very important part. And what you say about getting you involved before the purchase agreement, yeah, I would agree. I mean, why would you not want that second look from someone who really understands where the money is going to be coming from for that property?
That's absolutely the truth, because for me, if you are, it also doesn't hurt to build a relationship with a lender before you need them, right? Because that's part of what I see happen too. And when I say early, sometimes it may be like, you've been at this a while, so you have your lender relationships. If you're just getting into investing, connect with lenders early on, because then when you call and you need some help and some, commentary on what it looks like, they're not wondering who you are, right? There's this point where I think, understanding okay, in the world that I live in, I still do business with people. Yes, I'm looking at properties, but I'm still doing business with the people that are calling me about the property. And so there has to be a level of relationship there for you to understand what people are getting into. And I think that's a big piece of, yes, I'm looking at the property, but the person calling me on it and the relationship that we have is also very important to that process. And I think value can be added across the board. I've had projects where a guy calls me and he's like, "Hey, I have this project. I got a grant, and there's these grant terms, and I got to figure out my equity piece on this." I said, "Well, why don't I just bridge it with a revolving line of credit?" And he's like, and I just seen a light bulb go on, like, "Oh yeah, that would make this way easier for me. I don't have to go find $5 million and figure this out. I can just So there's real value, dollars and tangible numbers that can come out of those types of relationships."
As investors, we like to solve our own problems. And what you just described there is an investor, and I know who you're talking about, sharing the challenge with you, and you just bringing up something that they hadn't even thought of to really make it work.
And it comes down to where your expertise lies, right? Like you guys, you know so much more about investing in real estate than I will ever know. But in the world of financing real estate, that's where I live, right? Though that's my area of expertise. And when you can overlay those different areas of expertise, or the construction guy that comes in, and so you have an investor, a construction person, and a finance person, when you can overlay those levels of expertise, it goes back to bridging that gap of the lender and the borrower and getting everyone comfortable, because there's confidence that everyone has contributed their expertise to that particular project or that particular deal.
Talk about creativity in lending, because that's not really a word that's associated with banking and lending, but you do have a knack for coming up with creative solutions. So how do you approach creativity when it comes to putting together the capital stack and really making sure that you're leveraging the loan the best that you can for your borrower.
I don't know how many lenders, have man buns and wear just a sweater to work and just, kind of have just say, here I am. If you want to work, we can. But I say that in jest, but I guess that's the approach I take, right? Like, okay, I really see my industry is struggling from a very traditional mentality, right? There's this like, hey, give me 25%. I'll give you this, 12 to 18 month construction period with a rollover at a 5-year balloon with a 20-year interest rate, 20-year amortization. Very traditional structure. What I'm seeing, and when I talk about creativity, is like, look, these projects and the way these projects have to pencil out, that I'm sorry, you're not getting those types of deals to work. And so what I've tried to do is say, okay, what really has to happen to get this project off the ground and make it happen? And to me, it's, okay, I have to have an extended interest only period because the numbers don't work if you roll it over too soon and don't let it get fully stabilized and put it on longer term rates at the end. And so, with the rate environment we're in, I try and balance what rate environment are we in, what really is the stabilization, the construction and stabilization period. Let's give a little margin for error, there's our word again, what that actually is going to be and accommodate the actual need to the actual project. I think historically banks have said, here's the product we offer, fit into our product. And I try and go the other way and say, here's the project you're doing, how can I fit a product to your project? And I think that's where the modernization of lending has to, what I've tried to do is really make it more modern in the approach so it fits what's actually happening in the marketplace. Because that's the difference is that's just not, yes, there's projects out there like that, but you're only going to do so many a year if that's the approach you're taking.
How important to you is the story? Because I always feel like when I go out to get a loan on something, I feel like the telling the story and putting it all in the proper context is very important. And I'll bring up the Scenic Drive again. The story we told there was, well, this is a property that doesn't have the historical numbers to support it. This is a beach, Lake Michigan resort with cabins, houses, and the historical income just did not support the purchase price, which is why it was so hard for us to acquire a loan. But I feel like you and West Shore Bank were one of the only lenders to really understand the story and the potential. And you were actually, I think it helped that you had actually been to the property before and you knew the property. But how important is the story when you're looking at a loan?
I think that's such a good question, right? So I think I take a lot of flack from my colleagues over here because of how important story is internally, right? So there's a balance to understanding how that works. So you're going to bring me a loan. Let me kind of back into that a little bit, right? You're going to bring me a loan and tell me the story about it. And one, I have to buy into that, right? Like I have to have an understanding. Yeah. I feel like there's, we're narrative in nature, so I feel like stories always help. But what's going to happen is you're going to give me the story and give me all the information. I'm going to package it, and I got to turn around and I have to tell the story to the bank in order for them to sign off on me being able to do that. When you talk about story, you have to understand that stories get told a number of times. And so the importance of what that story is pretty high in my mind, because when I'm sitting in a room of 20 people presenting that loan, and probably even then someone's going to take that and present that for me to another group of people, your story is going to get repeated 3, 4, 5 times at an approval level, let alone all the outside planning conversations that happen around that same story. So I know that seems very like simplistic in nature, but that's really what's happening is you're telling me, I'm telling somebody, then I'm turning around telling another group, then that group's, and so it's gotta make sense all the way through. And being able to really sell what's there really stems down to, okay, but what is the story behind it? And so I think that's such a good way to put it in my mind, because it really simplifies what's happening in that process.
You just kind of peeled back a layer that most borrowers don't even think about, and that is the room where it happens. I mean, we're talking to you, Bobby Fisher, but you got to then go sell it to a room of 20 people who then have to sell it to more people up the ladder. I mean, what's the dynamic there? I mean, is it kind of like a college fraternity where everyone's just making fun of everything, or like what finds its way through in those types of rooms.
I'm really glad we're talking about this because this is one area where I'm like, I don't know why banks keep this such a secret because it would make everyone's lives easier if everyone understood what's going on here, right? So no, I've been so this is my third bank I've worked at. And the goal of each committee group is the same, right? Like, what are we doing? The idea is we want to lend money, but we want to lend it wisely is really the approach every one of these groups has been on. But every group has its own dynamics and personalities and different things. And so really a good lender understands the dynamics of the room he's bringing the deal into. I think you could attest this. I've been in conversations with you. I said, Brian, that's not going to work. And I'm not getting that through because I know what this group will go for. And I think if you're not getting that from your lender, you need to ask more of your lender because to me, a good lender knows what that group will do as far as the questions that will be asked and what they're looking for, because that is slightly different with each bank. And that's the other thing I was going to mention is, as you think about building relationships with the lender, every bank kind of has a slightly different dynamic to it. Like I spent a lot of time in commercial real estate. Some of my colleagues spend a lot of time in C&I manufacturing type loans. That's just not the world I live in. I haven't historically done that. And so you have to understand who does what. And your lender will cover a lot of that for you as far as what you can do.
When you're in those rooms and there's things that fly and things that don't fly, what are the top three things that don't fly? Like what is automatically just going to get you kicked out of that room and everyone's laughing at you?
Two things I'll point to is the equity piece is always important. Like the money that the borrower is bringing in has a lot of significance. And when I talk about, the traditional 20 to 25 becoming 30 to 20, 30 to 20, 25 to 30, that to me is why I say that is because of that, back to that margin of error thing. That's a big weight in the level of commitment from the borrower is why the bank sees it as that. It's like, hey, they have a significant amount of interest in making this work because they've put a good chunk of their own money into it. That's one piece. The other piece is the cash flow side of things. You talked about earlier the difference between residential and commercial lending being borrower-based versus property-based, in essence, that example. And the cash flow piece for the property gets, I would say, even more weight than the equity piece of that because we're not in the game of taking properties back. We're in the game of getting paid back. And so the idea is that the cash flow has to support what we're putting out there. And when I talked earlier about that gap between the bank and the borrower, the bank and the borrower, I really think that the assumptions, and especially on new projects, that's where so much time is spent is on the cash flow. So when we're in so much time in those meetings is spent on validating the payback ability and the cash flow piece, that is really where the two things I see are the most important in that room.
Is there more to that? I mean, you gave us two really good, solid pieces that help you in the room and help you sell it to the board and the committee. What else do they look at?
I would say, experience is another one. So experience, I say that not saying, hey, you have to experience to get a loan, but I think right sizing what you're doing with your level of experience, that's really where it lies, right? Like, so as an example, when I started lending, I was hawking $100,000 loans on owner-occupied commercial real estates for like mechanics, and really like I enjoyed doing it because it meant so much to the markets I was in. But over time, that 100 turned into 500, turned into $1 million, turned into 5 million. Like it seemed like every time you did something, you could stretch it a little more because you had a foundation of knowledge for the next one. And so I think, especially because I know you have a range of listeners, understanding that yes, you can stretch as far as where your experience goes and what you can handle as far as being able to deliver on the projects you're bringing, but understand it's kind of like, me as a community banker, I'm not going to be the CEO of JP Morgan Chase tomorrow, right? That's too big of a gap for my experience. And I think sometimes that microcosm and kind of boiling that down to a smaller level on a more local level, that comes into play. I've had people call me and say, hey, I want to do this. And back of my mind, I'm like, there's no way you're going to do that because you haven't even touched like the 3 steps you need to do that type of project. And I think a lot of time gets spent on, can the people deliver on what they're trying to do based on the experience they've had?
You want to make sure they've learned to walk before they try to run.
Exactly.
We've touched on a lot of different, I think, some of them are like secrets. I think some people will be surprised by some of the things they hear in this conversation. But as we wrap it up, what else, is there anything else you want to make sure our listeners understand about the lending process and how, they can approach it to be more successful in working with people like yourself?
I think it goes back to what we just touched on. We put it in a context of story, right? We said, hey, the story's going to keep getting told. But really, when you talk about partnership, Brian, if you have a loan that you need to get through, I'm the conduit that gets through West Shore Bank for you, right? So I think sometimes people, they miss that. I don't want to overinflate. Let me back up. I don't want to overinflate the importance of the lender in getting deals done, because there's hundreds and thousands of us all over the country talking loans, right? But what I'm saying is, when you do start working with a lender, your chance to get the financing goes through that lender. It's like electricity through the line. It's not getting to that house unless you go through that lender. And so I think that sometimes what we're talking about, and then kind of going back to that relationship piece, is making sure you're cultivating that relationship, because that's really the gatekeeper for what you're trying to do. So all these people who kind of go through and say, oh, I can't get anything done, I'm going to push back and say, what have you done to actually cultivate a relationship with a lender for them to be willing to go to bat for you in the rooms that we're talking about? And to me, I would leave you guys with that is, hey, you may have a really good idea, but you're not getting financing from a bank unless you have a lender that's willing to hear your story and share it. That's the difference, right? It's like, yes, a lender will hear your story, but are they willing to share it on the other side when they get back to the office? And that, to me, is understanding that dynamic is very important.
Bobby, how would people find out more about you, get a hold of you, find out more about West Shore Bank?
WestShoreBank.com for the actual bank itself. For me personally, so I'll say my email address solely. It's Bobby F, BOBBYF at WestShoreBank.com. But yeah, reach out to me via email. I'd love to hear from you guys. Feedback here. I really enjoyed this conversation today. I get a little amped up talking about some of this stuff because I find it really enjoyable. So no, I really appreciate it. But yes, Bobby F at WestShoreBank.com, BOBBYF at WestShoreBank.com.
What is your favorite hack or app?
It's got to be ESPN. I follow a lot of sports, and so that's going to be, I always am checking that one.
Which one is it?
ESPN app is frequent on my phone. Yeah, I follow a wide range of sports. So what I do with WNBA, NWSL, basketball, men's basketball, all kinds of different sports.
So the sport-loving lender, commercial lender. I appreciate you coming on the show. And you and I have done a number of deals together. And I think every single one of them, there's been an element of creativity and telling the story and really working with you, continuously, not just to acquire the loan, but after the loan too, to make sure that it's functioning properly. So I really appreciate you and all the part you've played in my portfolio and acquisitions. And I really appreciate you being on the show and sharing so much good information with our listeners. So thank you very much.
Appreciate it. Thank you.
I want to thank everybody for listening to this episode. I'm your host, Brian Hamrick from Hamrick Investment Group, and you can find out more about me by going to higinvestor.com. That's HIG investor.com.